Hello and welcome. I'm Josh Schimmels, publisher and CEO of the Los Angeles Business Journal. It's a pleasure to be here kicking off and hosting our first discussion on part of our 2026 real estate trends. It's our mid-year series, and today is a market update on office and industrial brokerage. Over the past several years now, right, we've seen significant changes in the office and industrial real estate markets. Rising interest rates, shifting capital markets, the constant evolution of tenant expectations and changing workplace strategies during, after, and then further out from COVID. All of these things have reshaped how owners, investors, and developers, and even occupiers approach today's market. So I think we all agree that while challenges still do remain, we're also seeing encouraging signs of stabilization. Transaction activity is beginning to return. Capital is finding its way back into the market, and many organizations are starting to reposition assets, and they're starting to adapt their strategies in order to capitalize on some of these new opportunities that we're seeing. Today's conversation is going to specifically explore the current state of the Los Angeles office and industrial markets. We're seeing momentum return in different places. So we're going to talk about what that looks like, how tenant expectations, capital markets, and transaction activity are shaping today's deals, which submarkets are outperforming, and where our panelists are seeing the greatest risks and opportunities over the next 1 to 2 years. We're joined today by two amazing and well-respected industry leaders who work right on the front lines of all of these trends every single day. They're going to share what's happening in today's market, what they're hearing from clients, what's keeping their clients up at night, where they see the greatest opportunities moving forward, and everything in between. So we're really excited to have them here and to get going. Before we jump in, I'd just like to extend our appreciation to our partners who are supporting this entire series. First, a very special thank you to our 3 diamond sponsors, CBRE, Logos Faith Development, and Trammell Crow Company. Thank you all so much. And next, I want to thank our platinum sponsors, City of Lancaster, Kidder Mathews, Nixon Peabody, Panko Builders, and University of Redlands, Los Angeles. Thank you all for your continued partnership. All right, let's get started. I have the pleasure of moderating today's conversation. I'm excited to welcome our panelists, Barbara Perrier, Vice Chair at CBRE, and John Anthony, Executive Vice President and Managing Director at Kidder Mathews. Thank you so much both for joining us. All right, as I mentioned in the introduction here, the commercial real estate market has been through significant change over the past few years, but we're starting to hear and see signs of stabilization. We're also seeing a lot of new opportunities that are emerging. So I'd like to kick things off with a question for each of you to respond to. As we look at where we are sitting today, all right, what gives you the most confidence about the future of the Los Angeles office and industrial markets? Barbara, I'm gonna have you start this one.
Great. Thank you, Josh. And there's a new trend that's happening that I'm pretty excited to talk about, specifically in the industrial market in Los Angeles, which is the rise of aerospace and defense. I think you'd be surprised that the #1 market in the entire United States for the first part of 2026 for manufacturing was Los Angeles. To me, that's a staggering factor. There was over 3 million square feet leased in the first part of the year in aerospace and manufacturing in Los Angeles specifically, which was an 86% year over year increase. Leading the charge was Anduril, who leased 1.8 million square feet in the Long Beach and surrounding Orange County areas, but we've also seen SpaceX and others, Northrop Grumman, and that is a very exciting trend. It gives me a little bit of a hope and a bright spot in LA right now. We've had a couple of tough years, which we'll talk about, but that is one of the shining stars right now.
Yeah, that's fascinating. We have written so much about this space in the last 18 months, and it continues to grow quite a bit. John, what are your thoughts? What are some of the opportunities that you're seeing?
Well, thank you, Josh, for having us. Excited to talk about these topics. Really, the news story for office leasing in LA, and certain, as we know, it varies submarket to submarket throughout Los Angeles, is the volume is back. I mean, coming out of the pandemic, we had nowhere to go but up. It's been a slow and steady recovery in submarkets and rather more substantial in others. And here in early 2026, we saw the highest volume of leasing we have seen since the pandemic. It gives us all a shot of encouragement that we're headed in the right direction. And you couple on top of that the fact that there's very little new inventory coming on the market. We are not seeing a lot of new office buildings being built, nor a lot in the pipeline. So those that are there, those that are delivering what tenants are looking for, are ripe to capture this ever-increasing volume that we're seeing in the leasing market throughout Los Angeles.
So it's all about the numbers right now. It's volume across the board, huh?
It certainly is. And coupled on top of that, we're seeing some of the inventory leave the market. And we're going to talk about that coming up as we see adaptive reuse and other creative ways to move some of these B and C buildings into different areas and different tenant bases than office.
Great. Well, let's hop back a little bit. Barbara, I want to go back to your initial comments on industrial. We all know, and we've seen extraordinary kind of a pull, a give, a take, a yo-yo response during COVID, where we saw extraordinary growth, and then we saw a little bit of a normalization of the industrial market. But now we're seeing growth again. Where do you see the industrial market settling? And I guess a good question to ask is, what does a healthy industrial market even look like going forward? What is that? How can you describe that?
So, Josh, you're correct. It's been a little bit of a yo-yo. It's been an up and down. It's been a little bit of a roller coaster. COVID was the go-go days. Then we went to kind of a decline. And now we're kind of stabilizing. And I would say that the infill LA markets are back and they're stable. And so those things that we're watching very closely to see if this is truly a healthy market are things like, are the vacancy rates going down, which they are? Is the tenant demand there, which it is? New construction has really kind of basically curtailed because of just some of the trends. So we're seeing all the indicators, not only of a healthy market, but of a recovering market. And I would argue that it has recovered. I would say the one thing about the LA market that we're never going to change is that we have these major drivers, the ports of LA and Long Beach for the industrial, and we have the population base, and those aren't going anywhere. So I feel like we were a little bit penalized the last few years because we had such a run during COVID. And after COVID, we started to see people that's not sustainable, the level of growth we had. But from my perspective right now, it is feeling so much better in 2026 than it felt in previous years. I am feeling way more optimistic about the market today.
Well, we love to hear that. And you're right, obviously, with the ports and just the population base. And now we hear a little bit more about the growth of manufacturing and aerospace. It's going to continue to support the market. John, let's talk a little bit about the deal itself. Okay. When we get down to the deal level, can you share maybe a recent lease sale or maybe a project that you've worked with that kind of helps best illustrate what's happening in the Los Angeles market today? What comes to mind there?
Well, one of the markets that I specialize in and that has been hit particularly hard is greater downtown Los Angeles, where owners, especially of B and C assets, are having to become very creative about how to either reposition their asset or make it attractive to those few tenants that are in the market. So we had a 40,000 square foot user office building on the periphery of downtown that unfortunately we lost our tenant. And rather than incur years and years of vacancy hoping to land that 40,000 square foot office requirement that probably wasn't out there when there's so much Class A space available that we're competing against, our ownership had the courage to go through the process to reposition the building and market it to charter schools. And we were able to secure a charter school, secure the e-occupancy requirements, and a long-term 25-year lease that gutted the building and converted it to a state-of-the-art school. It's now open, fully leased, occupied. And in that space, there's very little vacancy. So the future outlook for that tenant or for that landlord in that particular building going forward is fantastic, not only from the lease itself, but just the reposition of the building in the market. That's one example. Another project that I'm working on, which is in downtown proper, is a large office building that's currently vacant that we're very deep into negotiations now to convert it from office to boutique hotel. And that's another positive sign for those type of assets that are lagging behind the Class A office and can't attract the office tenants right now, on how to get creative and find a future in a very difficult market.
Well, that's interesting on both fronts. On the education side, I think we'd all agree anytime there's an investment in education, that is a positive thing all around. On the downtown office comment, I'm just curious before we move on, is there the occupancy in the hospitality market downtown to support, growth of hotel properties?
Occupancy is strong. It's not certainly where we'd like to see it, but with the World Cup that was here, the Olympics coming, there's a lot of optimism. Our convention center's undergoing a drastic change. We hope that will spur more hospitality demand in downtown. So it's more of a long-term play. The specific building I mentioned, it's 2 years out from the conversion. I think they're looking forward to that future market, not today's demand.
That makes sense. Yeah, no, that's great. Barbara, building off of that, what are your clients asking you today, maybe most frequently that a year ago even they weren't asking about, or you're seeing a change in the types of demand that's out there? What's new? What are your clients telling you?
Well, one of the most difficult things today is how to look at market rent. And so what my clients are asking is, how should we be looking at market rent? What comps should we be looking at? Because we've seen such a bifurcation of motivations of landlords where the rental comps are all over the map. And as you're underwriting a new deal, it is very difficult to know which ones to pinpoint. So we're seeing a lot of focus right now on really understanding a micro market, more so than in my career. I've been doing this a long time, over 38 years. And what I would say is the focus on the micro market, the exact size range that the building's in, the exact submarket, and maybe it's a submarket within the submarket, the neighborhood, really, really drilling down. So we're seeing a lot more of that. The other thing that's come into play a little bit more recently is clear height becoming a little bit more important and building quality. Whereas, we've seen, with robotics and automation, just the factors of the building, the clear height, the flat floors, et cetera, becoming more important to the tenants, and then that's more important to the investors. So those are two trends that we're seeing. But I would say for sure the most difficult is the market rent, just because it's been a choppy couple of years that we're just coming out of, and hopefully we're going to get some more homogeneous comps to make it easier. I feel sorry for the appraisers as well. They're having the same problem.
Yeah, I'm sure. And actually, as a part of this series, one of our panels is going to be specifically addressing how technology and AI is really assisting in identifying micro markets and identifying perfect fits for end users, exactly what they're looking for. And I know all the big brokerage houses, including yours, they're all using it. They're all part of it, and same with you, John. So let me ask you this. I mean, I guess, John, along a similar question, at the end of the day, it's the end users, right, who are shaping what the expectation of tenants are. How have the priorities of the tenants evolved over the last year or two, and how is it impacting leasing decisions? Because, in the C-suite as business owners and leaders, we're all getting the calls from the brokers asking us to talk about our leases right now. So what's shaping those conversations?
Well, in the office world, it's really come down to three things, and that's quality, the quality of the building, the amenities they offer, and flexibility. So when I talk about quality, I'm talking about those buildings that are having success in the office market right now are the Class A buildings, and not every Class A building, but really the best of the best that can offer efficiency, and by that I mean efficient floor plates, efficient ingress and egress. Safety, they're in a safe environment. The submarket is an environment outside of the building is generally safe. There's a huge focus within these buildings on the amenities they provide. They want amenities that draw their tenants and their employees back to the office. So there's a lot of capital going into improving on-site amenities and flexibility. We're seeing a lot of tenants wanting flexibility for their footprint throughout their lease term. It's no longer just, hey, we're going to sign our lease for 40,000 square feet, and that's what we're going to lock in for the next 10 years. They want the ability to expand that space, or in some cases, give back space throughout that term. And as the workplace demands change, so does their footprint demands.
Yeah, I would say we throughout the year, we report on quite a bit in the commercial real estate space. And one of the things that we've seen the most common in the office side is either the redevelopment or tenant improvement projects are just at an all-time high. The construction companies, especially those who work on office properties, are very busy and doing some really amazing things right now. Well, Barbara, let's talk about something that's really important, because at the end of the day, nothing happens without capital, right? Without funding, nothing happens. The market comes to a standstill. How is access to capital today influencing transaction activity? What does the market look like for that?
I would tell you that we've seen a lot of people on the sidelines for the past 2 years, but right now we're seeing people come off the sidelines, wanting to participate, having pent up kind of needs and demands. And that happens both on the buying and the selling side. Some people have held off selling because some of the trends we've just talked about, and others people have held up buying. We're starting to feel some meaningful kind of pricing discovery at this point. We're starting to see meaningful activity, and we're starting to see a market where buyers and sellers are actually in sync, which has been not the case for the last couple of years. In the heyday, I would tell you that in my practice, almost 95% of the deals that we took to market would close. Post-COVID, when there was uncertainty, we would see maybe 40% of the deals close, which was very unheard of. We'd have a lot more failed executions. Right now, we're probably hovering around 70 to 80% of all deals taken to market are happening. So it's feeling like capital is back. Capital wants to spend money in a meaningful way, and it's feeling much more healthy. The interest rate environment has been difficult, as we know, and I think you have another segment on, talking about debt. But what I would say is that I think finally people got to the point that this isn't going to change. We're not going to get back to that low interest rate environment that we had, COVID. So we just got to get moving and make things happen. So it's feeling like capital is back acting like we want them to, in a healthier way.
How does that 70, 80% differ from maybe 18 months ago?
So we have been slowly creeping up percentage-wise of deals closing. So I would say, 18 months ago, we were probably at 60, and now we're probably closer to 80. This year is feeling a lot more, most of the people that are on the market now understand where pricing is, and they're in there to sell it. They're not there to just to try to do price discovery. So it's starting to recover slowly, and hopefully we get back up to where most deals will transact. Yeah.
No, that's a big improvement, though. That's positive. John, back to specifically, let's talk about leasing. Okay. You know, you're seeing market conditions play out differently during negotiations today. Maybe dive even a little bit deeper when it comes to lease negotiations today. Specifically, what kind of trends are you advising your clients on, and how can they take advantage of that compared to maybe just a couple of years ago?
Well, as I mentioned earlier, it varies greatly from submarket to submarket, but in any submarket that you go to in the office sector within LA right now, it's very much a tenant's market. Landlords have to be nimble, they have to be flexible, they have to be aggressive. I advise everything is on the table. We're seeing concessions, obviously, in the rent department, but everything from early occupancy to free rent to parking concessions, letting unused TIs be amortized over the term and put back into the deal against the rent. You have to approach it with, and certainly it's more true in submarkets like downtown than perhaps a Century City, which is really seeing strong activity. Is everything is on the table. You have to be focused on cash flow, focused on occupancy. If the deal cash flows, make it. You don't know when the next deal is coming. So we are advising everything on the table. Be aggressive, be nimble, be flexible, and be creative, because there's not a lot of demand yet out there in most submarkets.
Flexible, creative, be nimble, all great advice for all of our listeners out there. Okay, Barbara, you mentioned a moment ago, you talked about price discovery. Let's maybe hone in a little bit more on that. As we're staying on the transaction side and we talk about, meaningful price discovery in the market, are we starting to see buyers and sellers come together, or are there still, pretty big gaps in valuations?
I would say we're starting to see the bid-ask gap narrow. We're also starting to see new players come into the market, and I think that's an important part of that kind of narrowing gap. So, REITs have basically been on the sidelines for the last few years. Our team just closed a significant transaction with one of the largest industrial REITs, which is great, because when those types of players come back in the market and we have a more frothy group kind of looking at transactions, we start to see that bid-ask spread narrow. And so back to that, kind of discovery of pricing, we had kind of record level low cap rates, in the COVID era. We had record high land values. People were feeling really optimistic about these things. And then it, kind of came down quickly. And so sellers were not ready to kind of understand and accept where the values had come down to. I think at this point in the cycle, everybody's on board, buyers are back. And the good news is that it's not just one buyer type. We're seeing, high net worth individuals, we're seeing REITs, we're seeing pension funds. The queues of redemptions have kind of ceased. So we're feeling that, all the kind of food groups of buyers are back.
Yeah, no, that's exciting to hear. I think we'll keep an eye on that gap and hope it continues to close even more. John, I want to kind of go back. You were talking about where the leverage seems to be in the market, and the landlords don't really hold that leverage today. So, as an owner or somebody that's leasing out, how are landlords repositioning their office and industrial assets in order to remain competitive in today's environment? Is it patience, or is it having to do something completely different?
Not a lot of patience out there. It's not a time to be sitting on the sidelines. You have to be aggressive. So we'd mentioned a lot of capital is going into these buildings, especially the Class A buildings. And where that capital is going in order to be effective and attract tenants is into the tenant experience within the building. So there's a huge emphasis on amenities and, your usual amenities like conference facilities and gyms and food service, but even more technologically advanced amenities. People are really putting a focus on the tenant experience from when they arrive at the building, go up to their suite, and leave the building. So we're seeing everything from a new way to approach and operate parking, a new way to get up and down the elevators, in and out of the building, perhaps have food delivered, coffee delivered to your space, interact with those amenities that are on site within your suite themselves. So technology is helping. There's a big investment in that, big investment on the normal on-site amenities. And second to that, there's not a lot of people that are waiting around to have, a space built out from shell condition, especially for the smaller to medium-sized tenant base. Those tenants with as many options as there are expecting that space to be in relatively move-in condition. So we're advising landlords, those spaces that are unleasable, let's get them spec'd out, let's get them ready and move-in ready, make it easy on the tenant. And those spaces that are second generation but good looking with a good efficient build out, let's get those moved in ready. The patience is certainly not on the tenant side. They want space that they can envision themselves walking into, setting down their computer and working in a pretty short order.
Yeah, that sounds about right from everything that we're hearing as well. We've heard the term submarkets come up a couple of times in this conversation. Barbara, can you give our listeners out there who maybe they're not real estate experts, but they know not just enough to make them dangerous and keep them knowledgeable. Give us just a really simple explanation of what you mean when you talk about submarkets, and then after that, tell us about which submarkets are outperforming expectations right now, and what is that based on?
Yes, so the submarket really is kind of the market within the overall, let's just call it Los Angeles area, and it's kind of a micro market or a smaller area. South Bay is the one that has done the best in 2026 and 2025. And the reason is the South Bay is closest to the ports of LA and Long Beach, which makes sense, right? The drayage costs are less, easier access to the ports, et cetera. But there's two reasons why South Bay's, really done better. So 88% of that 3 million square feet that were absorbed in advanced manufacturing and aerospace and defense was in the South Bay. So that's a new trend. And those are some B buildings, or not necessarily A buildings. We've also seen A buildings for warehouse and distribution lease up. So it's been kind of a trifecta for the South Bay, right? We've gotten both the traditional warehouse, which we see a lot of because of, trucking and ports access, as well as advanced manufacturing, aerospace and defense. And so that's the number one kind of, I would say, all eyes on South Bay. The good news is the South Bay tends to, in previous cycles, recover first, and then it goes out to the rest of the market. So we saw that. We're excited about that trend.
Yeah, that makes a lot of sense when you start thinking about the access to the ports, and obviously there's a very desirable component of living in the South Bay where there's access to live, work, play. Before I move on, let me ask you this: we've written quite a bit about the strength of the West Side and Century City. Are we still seeing that is it just as strong today, or is it starting to slow down a little bit?
So from an industrial perspective, not so much of player, but maybe John wants to answer that from kind of an office perspective.
Yes. I mean, the West Side, I mentioned earlier, Century City, which is probably the hottest office submarket in LA. Those are seeing the vast majority of the new absorption and certainly outdrawing some of the other submarkets.
Yeah, that seems to make sense. All right, so we're down to just a couple of more questions. I want to look further ahead as we kind of wrap things up. John, what types of assets, office, industrial, do you believe are the most vulnerable over the next flip side? And I'm going to save sort of the opportunities for the last questions from each of you. So let's talk about vulnerability. Where do you see the most vulnerability? Which is hard because I'm asking you to kind of look into your crystal ball here for the next 5 years, which is not easy to do.
Well, I spoke a lot about Class A office assets. So in the office sector, it's the B and C assets that are vulnerable. It's certainly those with poor parking, outdated amenities, everything from outdated common areas to outdated building systems, especially those with large amount of vacancies. Those are incredibly vulnerable. If you're an owner of one of those assets, your alarm bells should be going off, because your solution, it's not as easy as just a lower rent. There's plenty of lower rent options out there, and rent is not as big of a driver as it once was. People are looking for high quality assets and a better tenant experience before they're looking at the bottom line on their rent. So you have to be more creative. As I mentioned earlier, you have to come up with a specific plan for your specific Class B or C asset, or you're in for a very tough future. On top of that, in those submarkets that are weak, and certainly in those building classes like the B and C that are weak, and some of the A- stuff, if you've got debt coming due, soon, and over the next, 12 to 24 months, and maybe even a little further out, those assets are vulnerable, and you need to start thinking about your future, your strategic plan, because many of those assets, when their debt was taken, are the new basis is going to be considerably lower, and that's again more significant in some markets than others, but it's out there and there's vulnerabilities. And lastly, again, back to those B and C assets, if there's no logical and cost savings approach to an adaptive reuse, and you have a lot of vacancy, you're certainly vulnerable in this market going forward.
Well, and it seems like if you're a tenant and you're in Class B and C, and maybe a little bit of an updated or outdated property in general, it seems like you probably got a lot of leverage in your lease negotiations.
Yeah, what a time to upgrade. You can move finally from that B class building up to A, in many cases without a huge significant increase in your bottom line.
Yeah, that's great. We'll keep an eye on that. All right, so we are somehow, it seems like this conversation has flown by. So much great information being shared. I want to thank you both. We're down to our final questions, and it is a little bit of a look ahead, but I want to ask you to look 5 years out. Let's just keep it 1 to 2 years. What's one trend or opportunity in either the industrial or office markets that you think business leaders, owners, and investors really should be paying even closer attention to? So this is that one piece of advice that you're going to leave on. John, let's start off with you.
Well, again, there is opportunity out there in the office sector, and it's just what I would encourage investors to think about. It's not as simple as just buying a discounted office building that's vacant or struggling, that the debt came due, and we see that, hey, in 5 years ago or 10 years ago, they paid X for it, and we're getting it for 30, 40 cents on the dollar, and therefore we're getting a good deal. You really have to identify those assets that can attract long-term, that long-term can attract tenants, that long-term can be repositioned effectively. I would encourage investors to be more discerning about that discounted office building and really identify a future for it before just being sold on its discount.
Barbara, same question, closing thoughts.
Yeah, I would say that the multi-tenant market is a little bit of a sweet spot, and I think it's going to continue because of the lack of construction, and it's been kind of a little bit insulated from some of the market fluctuality that we've seen. And the reason is that those size tenants don't have places to go, and they tend to just stay and renew, and rents can kind of increase at a normal method. So my sense is the multi-tenant market is one to kind of look for in the industrial world. Also, user sales. We've seen a 25% increase in users who want to buy their buildings. And that's due to some of the new tax legislation on depreciation and some other things. So those are two things that I think will continue and are good opportunities for people who are saying, where can I make more money in the industrial world?
Yeah, that's great. And I think we're going to hear a little bit more about some of those tax law changes and how the community could take more advantage of that throughout this series and follow-up discussions. Barbara, John, I want to thank you so much for being a part of this and for sharing expertise, offering an invaluable perspective on the state of office industrial in the markets. Thank you both so much for being here. I think it's clear that what we've learned today is that the market continues to evolve, and there are at the same time meaningful opportunities for both sides of the fence, for the owners, also for investors, for tenants who seem to have a lot of leverage today that they haven't always had, and developers who, if they plan properly and if they think strategically, have some really great long-term opportunities as well. I want to always thank our partners for allowing us to do this. And I hope after today, you tune in again, because this really is sort of Real Estate Trends Week for us, because it's a series. We're going to have discussions each day that we're going to be launching. You can watch it online. You can read about it in the paper. You can listen to it when you're driving. We're going to make this all very easy for you. So we're going to continue to, in our next conversations, talk about capital markets, economic development, design, and construction. What does it look like? And then I mentioned the future of development. How is AI shaping innovation and opportunity across the board? And then lastly, I want to mention again, as we wrap the series up, make sure that you look out for the Real Estate Trends Mid-Year Series Recap issue, which is publishing on August 3rd. It's going to feature additional insights and Q&A responses from all of our speakers through the series, as we take what really is a comprehensive look at how the real estate market is reshaping Southern California right now. It's been a pleasure hosting you, Barbara and John. Thank you all so much for being here. And until next time.